The abrupt repeal of the 3 farm sector reform laws may impact the plan to boost food processing and exports from India. Business Today's Arnab Datta has the story.
आज मैं आपको पूरे देश को ये बताने आया हूं कि हमने 3 कृषि कानूनों को वापस लेने का, रिपील करने का निर्णय लिया है।
The abrupt repeal of the 3 controversial farm laws may have far-fetching implications for the country's food processing sector. The sector involves leading fast-moving consumer goods majors and a market larger than 2.6 lakh crore rupees. Leading companies like Nestle, Pepsi, Coca-Cola, Hindustan Unilever, ITC, among others, were ready with plans to leverage the benefits of direct sourcing of farm produce. Experts suggest that multiple aspects directly related to the packaged food and beverages industry now face uncertainty. The newly introduced 10,500 crore rupees production-linked incentive scheme for the food processing sector, aimed to grow farmers' income and expand India's packaged F&B manufacturing base, may have to be recalibrated. According to Confederation of Indian Industries estimates, the implementation of the laws last year had created a lot of traction in procurement of farm produce by industry. In states like Karnataka and Maharashtra, collection centers had been formed and companies were considering expanding such sourcing. The Federation of Indian Chamber of Commerce and Industry had also lauded the farm laws as much-awaited reforms for the food processing sector. According to FICCI, the laws would have raised productivity, incomes and generated employment. While industry has remained tight-lipped after the announcement by Prime Minister Narendra Modi, past remarks by industry suggest a rethink of business plans may be unavoidable. Bureau Report, Business Today Television.
In some good news for equity investors, as per Morgan Stanley, India will continue to outperform other markets driven by a new profit cycle. Morgan Stanley sees the Sensex at 70,000 by December next year, but this will come along with higher relative volatility. In a bull case, Morgan Stanley believes the Sensex could hit 80,000 in 2022 and hover around the 50,000 mark as a bear case. But there are many challenges for the markets ahead. Rising oil prices, potential third wave of COVID, upward inflection in domestic interest rates are some of the hurdles as per Morgan Stanley. Amid the IPO rush on Dalal Street, SEBI has proposed tighter listing rules. The move is aimed to protect small shareholders who are looking to invest in a flurry of new age technology firms listing on the bourses. Here are the proposed changes that may help you as an investor.
With a large number of new age companies making their way to Dalal Street, market regulator, the Securities and Exchange Board of India, or SEBI, has proposed to tighten rules. Looking out for small shareholders, the regulator intends to regulate how companies spend cash raised through IPOs and how quickly big investors can exit. Let's take you through some of the changes that SEBI has proposed. First, a limit will be set on money raised from IPOs that startups can use for mergers and acquisitions. As much as 35% of the IPO issue can be used for inorganic growth initiatives and general corporate purpose. Companies will be required to reveal the portion of the IPO proceeds that are likely to be used. The regulator has also proposed that divestment of stakes by significant shareholders be capped at 50% of the pre-issue holding. The move is aimed at reducing the risk for investors who are investing in the IPOs of new age companies based on their popularity. So will investors benefit? For starters, investors will know how their money will be used. The market watchdog may also increase lock-in period for anchor investors to 90 days in order to provide more confidence to the public. For those startups planning IPOs in the coming days, it will be essential for them to make investors better informed about their business and future plans. Bureau Report, Business Today Television.